Sales type leases. So sales type leases and direct financing leases only matter if you're the lessor. For the lessee, accounting exactly the same. So, because there is no differentiation. So, if you remember, back a couple pages. For the lessee, we just have operating capital, and the accounting is the same for all types of capital leases. For the lessor, we have these two different types: direct financing and sales type capital leases. So the sales type is really just for the lessor. So if the lessor is a manufacturer or dealer, the fair value of the lease asset generally is higher than the cost of the asset. So in other words, they're paying some smaller amount for the asset and then leasing it for a larger amount, because they can also sell it for that larger amount, potentially. At the inception of the lease, the lessor will record a cost of goods sold as well as sales revenue, which is the present value of the payments. In addition to interest revenue earned over the lease term, the lessor records profit on the sale of the asset immediately. So this is essentially, they're accounting for this as a sale, even though it's also a lease at the same time. So here's our example. On January 1st, 2011, Guyman Inc. leased a stump grinder from Blunck Corporation once again at a price of $9,985. The lease agreement specifies annual payments of $2,000 beginning January 1st, 2011 at the inception of the lease, and at each January 1st thereafter, which we decided this should be 2016. The 6-year lease term ending December 31st, 2016 is equal to the estimated useful life of the grinder, and Blunck manufactured the grinder at a cost of $8,000. So this is the new information, that Blunck manufactured the grinder at a cost of $8,000 and then is leasing it to Guyman for $9,985. The difference between the two tells us this is a sales type lease. If Blunck had manufactured it for a cost of $9,985 or purchased it for $9,985, then it would be a direct financing lease. But since there is a difference, it's a sales type lease. Blunck's interest rate for financing the transaction is 8%. So, just like the last example, everything's the same, and so it's still a capital lease, but now it is specifically a sales type capital lease because of that profit that is happening, and because Blunck Corporation is a manufacturer in this case. Is that right? Yeah, yes. Manufacturer. So, Blunck Corporation is a manufacturer. The journal entries, we're only going to do it for the very beginning, because really the first journal entry is only the one that's different. Everything else is exactly the same as what we just did for the direct financing lease. So only the initial journal entry for the lessor changes. Everything else, exactly the same. Okay, was that clear? Only one journal entry changes. The lessor's journal entry at the beginning is the only journal entry that changes. So just so we remember, last time, this was the journal entry by the lessor. Lease receivable, property, plant, and equipment, 9985, 9985. This is what it was last time. This time, we're still going to have a lease receivable of 9985, because the lease receivable is always the present value of the minimum lease payments, which nothing has changed from the last time, so that's still the 9985. But this time we're going to record sales revenue for the 9985, and we're going to reduce, and this time I'm probably going to call this inventory, since we are now a manufacturer and we're selling this. We're going to call this inventory. That was on our books at $8,000, and we're going to have cost of goods sold for $8,000. So at the inception of this lease, we're going to have profit of the 9985 minus the $8,000, because this is a sales type lease. The difference between these two numbers tells us it's a sales type lease. If these two numbers are the same, then it's going to be a direct financing lease. Does that make sense? Any questions? Concerns? Receipt of the first lease payment, it would just be like before, and so nothing has changed here. I'll just write it down.
So for the lessee, it's the journal entry didn't change.
Nope, it did not. It does not change, because it doesn't matter what Blunck paid for it for them. For Guyman, it doesn't matter what Blunck paid for it. So So nothing changes for Guyman. Theirs is still 9985. So the only journal entry that changes is this guy right here changes to this guy right here. Other than that, everything else is exactly the same. So as a quick reminder, and it didn't say anything in this problem about it, but to be able to do this and to record this sales revenue, we have to have these two things be true. Collectibility of the lease payments must be reasonably predictable and assured, and if any costs of the lessor have yet to be incurred, they are reasonably predictable. These two things must be true to be able to record that sales revenue right there. Just like any other time we record sales revenue, we've done the work and pretty sure we're going to collect the cash. That's the basic idea. Alright, so we've now done 3 types of leases. So on the exam, as I described before, there's going to be a variety of different types of leases, and you're going to have to identify from the information what type of lease it is, and then record all the journal entries associated with it. We've seen 3 of them so far. Operating leases, you've seen an example, direct financing leases, and sales type leases. Now there's only one difference between a direct operating and a sales type, and so they're very, very similar except for the initial journal entry for the lessor. But, so we have three types so far, and we're going to add another at least 3 more types, maybe 4 more types, before we're done at the end of class next time. Let's get a hand.
So I guess you find out it's a direct finance lease
By no profit.
by no profit.
Yeah, that's what tells you that it's a direct financing lease. There's no profit associated with this for the lessor, then it's a sales, and then it's a direct financing. Alright, so we've done 3. Here's our 4th one. Bargain purchase option. Alright, we're going to know what a bargain purchase option is. And so we're going to talk about what changes in the accounting. So a bargain purchase option is a provision of some lease contracts that gives the lessee the option of purchasing the leased property at a bargain price. The expectation that the option price will be paid effectively adds an additional cash flow to the lease for both the lessee and the lessor. Okay, so here's the key point for the bargain purchase option. We assume it's going to happen. And so basically, that bargain purchase option just becomes another lease payment. Does that make sense? So we assume it's going to happen, and so that bargain purchase, the price that's paid to buy it, just becomes another lease payment. When a bargain purchase option is present, both the lessor and the lessee view the option price as an additional lease payment, as I just said. The lease term effectively ends when the bargain purchase option is exercisable. Thus, if a bargain purchase option is a 6-year lease, could be exercised at the end of the 5th year, the effect will be to change the lease term to 5 years from 6. So we said that again. As soon as a bargain purchase option becomes available, the assumption is it will be exercised immediately. And so if the lease term is 10 years, but a bargain purchase option happens at the end of the 5th year, the lease term is 5 years. Does that make sense? Okay, so the lease term is only going to be until the bargain purchase option is expected to be exercised or when it becomes exercisable. As a result, the lessee adds the present value of the bargain purchase option price to the present value of the periodic rental payment when computing the amount to be recorded as the lease asset and lease liability. So as a reminder, for the lessee, the amount that they put on their books as an asset and a liability is the present value of the lease payment. So this is now a lease payment, so it's going to be included in both those numbers, the present value of it. For the lessor, when computing periodic rental payments, we subtract the present value of the bargain purchase price from the amount to be recovered, the fair value, to determine the amount that must be recovered from the lessee through the periodic rental payments. And you'll see what I mean when we do our example. That one's a little trickier to understand right off the bat. Here is our example. Bargain purchase example. On January 1st, 2011, Guyman Inc. leased a stump grinder from Blunck Corporation at a price of $10,000. All right, so we're giving you slightly new information here. Lease price, $10,000. The lease agreement specifies annual payments beginning January 1st, 2011, the inception of the lease, and at each December 31st thereafter through 2015. the estimated useful life of the grinder is 7 years. All right, so we're changing a number of things. The lease value is $10,000. They are making the first payment January 1st, and then every payment after that happens December 31st, so we don't have to mess with adjusting entries anymore. We did it on that one, so you can see what would happen if we had to do adjusting entries. No more adjusting entries for the rest of these. So on December 31st, 2016, at the end of the 6-year lease term, so the lease term is 6 years, the useful life of the grinder is 7 years, the grinder is expected to be worth $1,000. So after 6 years, the grinder is expected to be worth $1,000, and Guyman has the option to purchase it for $500 on that date. So at the end of the 6-year lease term, Guyman can buy the grinder for $500 when it's worth $1,000. The residual value after 7 years is 0. Blunck manufactured the grinder at a cost of $7,000, and its interest rate for financing the transaction is 8%. All right, so let's make sure this is a capital lease. What tells us this is a capital lease?
Bargain purchase option.
Bargain purchase option, boom, capital lease, done. Don't have to do anymore. So if we want to do the rest, it's more than 75%. Present value of the minimum lease payments is probably greater than 90%. Let's think about that for a second. It is going to be, because it's going to be 10,000. All right, anyways, so this is going to be a capital lease. Is it a sales type or direct financing?
Sales.
Okay, how do we know it's a sales type? Because there's profit associated with this. The cost was $7,000, it's being leased for $10,000. So we're going to have a sales type lease for this particular example. Alright, so the next thing we need to do is we need to figure out the amount of the rental payments or the lease payments, because the problem doesn't give it to us. And so if we are the lessor, we have to figure out what the right amount to ask for lease payments are to make the information that we have been given to be true. So basically for $10,000 with the information that we are given. So we're going to draw a picture. It's going to look very similar to one we did earlier with one difference. We're going to have payments. The first payment happens at the first date, and then next one happens December 31st, December 31st, December 31st, December 31st, December 31st. And then there's one more payment that is going to happen at the end of the 6-year lease term. 1, 2, 3, 4, 5, 6. This is going to be the bargain purchase option that happens right here, and then the asset's going to last for 1 more year, is the expectation. So this $500 is considered a payment, essentially. And we already know its amount, it's $500. So now, and we know the present value of all of the payments must be $10,000. Wait, yes, $10,000. And so now we can solve for what these payments must be. Okay, so how are we going to do this? Well, what we're going to do is we're going to take this $500 right here, and bring it back to today. Because we want to get rid of that amount so that we can just look at the rest of the payments by themselves without that different number, $500. So we're going to take the present value of $500, brought back 6 periods at 8%, and we're going to find out that this $500 multiplied by 0.63017 equals $315. So the $500 brought back to today is worth $315 in today's terms, discounted 8%. So now what we're going to do is we're going to take the $10,000, which is going to be the present value of all of the lease payments, and we're going to subtract the $315, and that amount, the $9,685, must be the present value of all of the other lease payments. Does that make sense? Okay, so the $10,000 must be the present value of all of these, including this $500. So if you get rid of the $500, bring it back to today, $315, subtract that from $10,000, which is in today's terms, the $9,685 must be the present value of the rest of the payments. Now, just like we did in our previous example, we're gonna figure out the payments by saying 9685 is going to equal X times the present value of an annuity due, how many periods? 1, 2, 3, 4, 5, 6, 6 periods, 8%, which is going to be 4.99271. Solve for X, and it must be 1,940. So with 1,940 paid at each of these X's, and then $500 paid right here, if you present value all those cash flows back, $10,000 is the present value of all those cash flows. Does that make sense? Does that make a little bit of sense? Does that make no sense?
That makes sense.
Yeah, December 31st, 2016. No, it's going to be the end of 2015. This is January 1st, 2011, December 31st, 2011, 12, 13, 14, 15. So December 31st, 2015 is the last payment. And then $500 paid at the end of 2016. All right, so if you are the lessor, this is what you're calculating. You know that the value of, if we just sold this thing today, it'd be $10,000. We're going to get an 8% return on this lease, and so this must be our payments. So that's how the lessee figures out the payments. If you are, that's how the lessor figures out the payments. If you are the lessee, then you were just given this information. You were given payments of $1,940, and there's going to be 6 of them, plus a bargain purchase option of $50. Then you basically work the opposite direction. You would take this, multiply it by this, get 9685, add the 315, and you get $10,000. That's how you figure out the present value of the minimum lease payments